Let's resume our conversation with Brooke Thackeray. He's watching three main drivers influencing the Canadian dollar, which is off, Brooke, so far this year after a pretty sharp rally at year-end last year.
Yeah, if we take a look at the Canadian dollar, it's been trading in this range from 72 cents to 76 cents. We're in that midpoint of the range for the Canadian dollar. If you take a look at the drivers, the big drivers are the price of oil, because we're still a petrol currency somewhat. And well, here you can see the Canadian dollar, it's come back down there from the 76 level. We're at the midpoint. We've been on that decline. Part of that's been, if you take a look at the US dollar relative to world currency since the beginning of the year, it's actually been rising. So when the US dollar rises relative to world currency, you'll see the Canadian dollar will actually come down. And here's the spot price for that. So you can see that rise since January. So that's been impacting the Canadian dollar in the short term. So the two-year yield is another influencing factor as well, the difference in how fast they're moving between Canada and the U.S. And that really hasn't had an impact.
In terms of central banks and who cuts first and who cuts by the most over a period of time.
Absolutely.
Or market perceptions thereof.
Yes, absolutely. Right. And overall, I think the biggest factor right now that's been pushing down the Canadian dollar is the strength of the U.S. dollar relative to world currencies. The good news is we're coming into the seasonal period for the Canadian dollar to perform well, which starts in mid-March and runs through for the month of April. So here we are in the midpoint. I'm actually quite favorable on the Canadian dollar coming up shortly relative to the U.S. dollar.
Why does April tend to be a strong seasonal month for the Canadian dollar? Any reason for that?
There's a couple of reasons. First of all, commodities tend to do well in that time of the year, in particular oil. So we tend to see oil stocks doing well. Also as well, it's just the flows for the government funds in Canada versus the U.S. are different, which tend to help the Canadian dollar.
When Canadian investors purchase ETFs, let's say on U.S. securities, so perhaps an ETF that tracks the U.S. stock market in one way or another, they often have the choice of choosing a unhedged or hedged version of that ETF, and a version of the ETF that leaves you fully exposed to the exchange rate or hedges out the exchange rate by hedging back to Canadian dollars. How should investors think about that at a particular point in time?
Well, you're absolutely right. What investors are doing when they're buying an ETF in Canada that trades in the U.S., they're making a decision on the actual investment and the currency. So there's two decisions with that investment. And if you're hedging, that means that you're saying, well, the Canadian dollar is going to do better than the U.S. dollar. So it could be an equity investment, but that's your
Another way to think about that is I'm investing in U.S. securities, and if the Canadian dollar outperforms the U.S. dollar, the value of the U.S. dollar, and therefore their securities is going to be pressured down, correct?
Yes, absolutely, yes. And so at this point, you would prefer, if you believe that the Canadian dollar is going to do well, coming up shortly, you'd say, well, I want to be hedged to the Canadian dollar for that investment.
All right, there's a live look at the scorecard in North America. Some early weakness in Toronto and for the S&P 500. The NASDAQ, which had struggled in recent days, is finding a little bit of buying interest. And that's where we want to start our next conversation, because we've talked about multiple record highs for the broader S&P already this year. But in many cases, those were driven by a handful of technology stocks, which in some cases have been described as the Magnificent Seven. Our next guest feels that there is more risk baked into the markets because of that outperformance from big tech. Mike O'Rourke is Chief Market Strategist at Jones Trading and one of our regular guests. He joins us now. Mike, walk us through your thinking. What's on your mind?
So, John, at the beginning of the month, that was the peak of this earnings season. February 1st, I think it was, Meta reported, Apple reported, Microsoft and Amazon reported right around then as well. And obviously last week we got the report from NVIDIA, and Tesla had reported in late January. And what I believe has unfolded over the course of this earnings season is there have been definite winners and losers among this group of, major technology names. Simply stated, Meta and NVIDIA came out the big winners, and that obviously post its earnings report last week, one day NVIDIA added $277 billion in market capitalization. The previous record was what Meta reported earlier this month. I think it was somewhere around 180 billion that they added in market cap. And so what you're seeing here is a bifurcation develop where these companies have good growth prospects, lower valuation multiples than the other members of the group. And then you're seeing some members struggle a little more, specifically Apple and Tesla. Apple's revenues this year are supposed to be essentially flat, up 1%, 1.5%. And Tesla's revenues are supposed to grow about 14, 15%. But obviously, if you watch the news, we've seen all types of EV headlines about a slowdown in the business globally. And then you're left with the three other names, Microsoft, Google, and Amazon somewhere in the middle. So I think that's the shift that we're watching for here now.
Now, I'm looking at the average analyst target prices on Wall Street for the Magnificent Seven, Mike. And just like everything, every piece of advice people get, nobody knows the future, so everyone's making their own predictions. But the analysts who cover all of these companies, on average, do think that the stocks will be higher, every one of them actually, in this group in a year's time. Now, are these the same kind of returns we've seen, call it over the last year or so? No, but I'm just looking at return expectations for the whole group between, call it, 8 and 19%. So that sends a message to me that the analysts who cover these companies are a little bit reluctant to make bearish calls right now. Heck, I spoke to one analyst from Wedbush who thinks that in a year's time, Microsoft and Apple will add another $1 trillion in market cap. So how do you balance out your concern with that more bullish sentiment?
Well, of course, on those names, they're market leaders, they're major companies. 99% of the time, the sentiment on those names is going to be bullish with higher price targets. And if being that those views rarely pivot, I don't think there's much value in that. That said, I'm talking about the competition for investor dollars within the group. And I think the divergence in fundamental performance in the companies is so great, and the valuations are so disparate that investors are going to, they're going to favor NVIDIA and Meta platforms over the likes of Tesla, Apple, and to some extent, Apple, Google, and Amazon. Again, it's one of those things where a lot of the move among the entire group has been multiple expansion throughout last year, where the valuations have moved much quicker than the fundamentals. So that's a risk factor there that investors need to be aware of. But when you see some members have their growth slow down, expect investors to look elsewhere for opportunity.
Where would you be looking elsewhere right now?
Well, right now, I think this group is due to consolidate. I expect that they'll churn, and that's going to lead to a churn in the S&P 500. I think as we sit here, we look at the interest rate environment, it looks a little more stable than people were expecting at the end of 2023 and the start of this year, that you're seeing investors shift back towards value, shift back towards financials, shift back towards energy, shift back to small caps to some extent, now that they've corrected after their fears about rate cuts not emerging have started to price through that market.
It's interesting. We're covering Canadian financials today because the big banks up here are going to be busy reporting results this week. And already this morning, we were highlighting that there are some challenges. Bank of Montreal, which has some notable exposure to the U.S., just pulled off a huge acquisition there. There's been this dialogue around exposure, more broadly speaking, in this higher interest rate environment to things like commercial real estate. And so I guess in the short term, what we're seeing in real time investing in Canadian financials is what feels like some choppy waters. So what's the primary question, as someone who has long championed some of the financials in the United States, what's the biggest question a bank-related investor should be asking right now?
Well, the story about commercial real estate's not a new one, right? And that's a good thing. Investors are aware of the risk in the group, and that creates that choppiness. But that choppiness is also opportunity. I think one of the issues that investors have been concerned about is, are there going to be big losses in this space? And now, as we shift towards expectations of a softer landing, that's a benefit that shifts, in favor of the financials or the banks, that maybe the risks or the losses that people feared are not going to be as severe as people expected. But overall, the valuation of the group is attractive. That's why I like it. I think the risks are well advertised. And I think that's when you want to buy things. You don't want to be chasing the momentum out there because if you get caught on the wrong side of that, it becomes very painful.
We talk a lot about the pipeline stocks in Canada. Some investors love them for their big yields, although Enbridge and TC Energy have been lagging the broad market over the past few years. Let's focus now on a US player, ONEOK. OKE on the New York Stock Exchange. So there is a look at the US stock over the past 5 years. So it is ahead marginally of TC Energy and Enbridge. The company just came out with estimates. It beat analyst expectations for its first full quarter. And the company just closed a $19 billion US acquisition of Magellan Midstream Partners last year. Our guest says the company is signaling a favorable outlook for the year ahead. We're joined by Tristan Richardson, Managing Director at Scotia Capital. Tristan, it's great to see you. Really appreciate you coming on the show. Could you just set the stage for us? ONEOK, how would it differ, for example, from a TC Energy or an Enbridge? I know you don't follow those companies as closely, but what's distinctive about ONEOK, please?
Sure, my pleasure, Andy. ONEOK is a diversified U.S. player, primarily focused on moving energy across pipelines in the United States. They focus on not only natural gas, but also refined products, crude, and most importantly, natural gas liquids. So think propane and butane, and getting it to demand centers like the U.S. Gulf Coast.
Have they been affected by these glutted natural gas markets over the past while? I mean, does a low natural gas price hurt them? Actually,
because we have such abundance of production of natural gas, not only in Canada, but also the United States, you're seeing actually constraint on many of the U.S. natural gas infrastructure across the country and the continent. And most in particular, one of ONEOK's natural gas pipelines, the Northern Border Pipeline, has been full and has been full for years. So an abundance of natural gas means more volumes and more volumes through the pipes.
And generally that's good for them, obviously, higher volumes.
Higher volumes, higher fees, higher earnings, higher cash flow, higher dividends.
They took out this company, Magellan. Was that okay? Investors were okay with that? That they didn't load up the debt excessively, for example?
That was an interesting transaction. It really added a ton of scale for ONEOK. And really what it did is they were able to prove to the market, not only in this most recent quarter, that the synergies that they identified when they first announced the acquisition are achievable, but they're actually seeing greater synergies than they otherwise would have planned. And so the cost synergies associated with this merger, the tax benefits associated with this merger are starting to prove out in the most recent quarter.
And the yield, do people buy this stock, I presume, or a lot of people buy the stock for the yield, the dividend yield I'm showing here, about 5.4%.
So, Andy, we think one of the most important things to look at is really free cash flow, because as free cash flow grows, not only can you grow the dividend, but you can also buy back shares. ONEOK announced a couple of months ago a $2 billion authorization to repurchase. And it not only did it announce that authorization, but it also signaled that it intends to use it over the next 4 years. So we think through increasing dividends and increasing buybacks, you see a lot of cash come back to the equity holder.
What about a takeout? Could this company in itself get swallowed in Pac-Man fashion?
Andy, I think we think about it the other way around. As ONEOK has proven that the Magellan acquisition made sense, the stock has done well. Their leverage is very low. So they not only have equity currency, but they also have balance sheet capacity. We think over the long term that ONEOK is actually more of a consolidator of the space than necessarily a takeout candidate.
And tell us, I think you said they have a refined pipeline product. So are they actually putting petroleum, for example, through some of their pipelines?
That was one of the attributes that Magellan gave them is exposure to the refined product market, which, as you know, is a very stable market. And so not only the legacy ONEOK, which is primarily focused on natural gas and natural gas liquids, Magellan really gave them a very large footprint in refined products. So they are moving refined products from the refining hubs, and think of the U.S. Gulf Coast, out into demand, particularly in the Midwestern United States, across Texas, all over the country.
I got to admit, do people actually move gasoline by pipeline over long distances, or I'm being naive here, maybe?
Absolutely. That's how the majority of gasoline, motor fuels, diesel, jet gets its way around is through pipeline. And it's really only those last few miles, or those last 50 to 100 miles, where you will see it trucked to trucking depots, as well as as you would think, petrol stations.
Doesn't that make isn't that dangerous? It sounds dangerous having a pipeline full of gasoline, but I guess they've been doing it for a long time.
I think more a truck carrying 10,000 to 100,000 gallons of petrol going at 80 miles an hour down the highway. I think a pipeline actually might empirically prove out a little bit safer than trucking over the long term.
Yeah, whatever you think of hydrocarbons and climate change, it is a miracle that they get all this fuel out there at a price per litre less than bottled water. Leave us with a final thought. Is a stock like OneOak going to do better if and when interest rates fall in America? I mean, it'll cut their cost of capital and make their dividend more attractive.
That's certainly a factor. Well, we have an $86 price target on OneOak. Our thesis here really comes down to, as CapEx comes down and as EBITDA and cash flow grows, there is much more free cash to come towards the equity holder in the form of growing the dividend 3 to 4% over the long term, as well as slogging away at a very big repurchase authorization. And that to us seems that presents the upside for OneOak.
You are watching Trading Day. I'm Amber Kanwar. EQB is one of our trending trades. It's the worst performing stock on the TSX today after reporting a rare earnings miss. The bank reported higher expenses, higher provisions for credit losses, and a spike in impaired loans. But on the flip side, the bank increased their dividend and gave a forecast that suggested that better days are ahead. We should also point out that the stock is pulling back from a record high. We've got Andrew Moore, President and CEO of EQB Bank, joining me on the desk. Thanks so much for being with me.
Thanks for having me, Amber.
Well, I hope I did a good job at balancing, what's going on. It's never easy to come on when the stock is pulling back like that. But there were some areas of weakness that the market decides to focus on today, particularly that spike in gross impaired loans. What's happening there?
So, I mean, just to put the broader context, by the way, we're the top performing bank on the TSX over the last 20 years. So, today may not be the best day, but over 20 years we're the top of all the banks listed. So I think what we are seeing on impaired, we're certainly seeing with the Bank of Canada increases, that's creating some stress on our borrowers in our single family business and similarly in our commercial lending space. But I say, and what we talked about on the call this morning, we're very comfortable that the losses are going to be very modest. Yes, we have to restructure some loans and that sort of thing. But so the impaireds rise, but we're not expecting much in the way of provisions.
To realize those.
Unfortunately, in commercial, it takes 6 months, a year sometimes to actually work out of a problem loan. But we're always in first lien position. We're secured against great real estate in great Canadian cities. So our expectations about loss are very modest.
But it's the second spike in a quarter, and there were concerns on the call, and you did address that. And is this something we're going to have to get used to seeing this year?
I think we're going to see a bit of reversion as the Bank of Canada starts to go into more of an easing cycle, and obviously we debate endlessly about when that's going to happen.
Yes.
I think we'll start to see this recede. Certainly in our commercial business, our commercial real estate business, our expectation is that the impaireds will drop in this current quarter. In fact, we're very confident they'll drop this current quarter.
Give us a sense of what if rate cuts don't happen at all this year, which I don't think is outside the realm of possibility. Growth numbers are coming in better than expected, and those rate cut expectations keep getting pushed out.
I mean, obviously that stresses some borrowers, but in general, of course, there's a fundamental demand for housing in a growing economy and an economy with more people moving into other parts of the world creates demand for housing. So maybe the impaireds look a little higher. I still don't see credit losses really change very much. but certainly it will put some stress on some of our customers.
Well, let's talk about that profile on the demand side for housing, for mortgages to finance that. Your business does capture entrepreneurs, but also immigrants, and we've experienced a record influx of immigration. On the ground floor, what can you tell us about maybe the credit qualityness, the credit quality of these people coming to the country, how much that's driving incremental demand for you?
Yeah, it's driving that demand. I would say that when people first come to the country, they're more likely to rent accommodation and then sort of get settled with a job and so on and so forth. But sort of 2 or 3 years down the road, that certainly turns into demand for housing and demand for mortgages. We also fund a lot of apartment buildings, so that's great. And the credit quality of these people is very good. I mean, I just generally take the view that somebody who's moved halfway around the world for a better life in Canada tends to have a huge, work ethic and the desire to keep their mortgages current, and that's actually what we see. And it's almost a family enterprise, often multi-generationals helping buy their first home in Canada and making sure they kind of establish their family life in Canada. So it's a great profile from our perspective. You
mentioned the length of time EQB has been a public company, 20 years, 1,000% returns.
Yes, exactly.
Yeah, right. That's right. But you're also kind of introducing yourself to Canadians, new Canadians who are coming in. I noted that expenses came up, and I wonder how much of that had to do with Eugene and Dan Levy, who are now featured in your commercials.
Yes, well, and in Quebec, we have 2 iconic Quebec actresses who've really resonating there. So what we're trying to pull apart here is the idea that so many Canadians bank with the first bank that they ever went into, and we offer better value. So we offer interest on the savings account, no fees.
There he is, Eugene's telling that right now.
He's brilliant. I really think he's a fantastic actor.
Did you get to meet them?
I only met them kind of over Zoom through the but it was a huge excitement actually to kind of have a chat. But clearly, geniuses in their craft, and I really like the way they got this tension of. Why are we still banking with the same banks? And I'm not saying necessarily it's such a bad thing, but on the other hand, when we think about, we used to go to Blockbuster, now we go to Netflix, and so many other categories of life, we've changed vendors. Banking's one where many people are still with the same provider, and we do believe we offer a better option. So that's what the advertising is bringing to life. And you'll note in our report that we talk about a number of customers for EQ Bank being up 38% year over year. We're adding about 500 new customers a day, if you can imagine, just kind of signing up and opening a bank account through this advertising and word of mouth with their friends and families. So we're really excited about where that takes us over the longer term. Canada's leading digital bank now, we believe, in terms of our capabilities.
I'd love to get your perspective as an executive, a C-suite executive, just how things feel to you about the Canadian economy. I mean, we're still kind of thinking about maybe a slowdown, maybe a recession, though the growth numbers we just kind of fly in the face of that. What do you see? What does it feel like is coming down the pipe?
Yeah, it's one of the more curious times in my career, frankly, because it's still relative. The employment's still really good, and people can get jobs, and it's actually quite tough to hire good talent. And at the same time, you've got this high interest rate stress on people. So it's a bit of a mix. I would say that the economy feels better than one might imagine, given this enormous tightening. But I also have a lot of confidence. The Bank of Canada's got it. They've dealt with this inflation issue. It's behind us. In effect, I mean, it's just a matter of time now before we start to go into a bit more of an easing cycle and inflation gets back to target levels.
Let's talk industry trends. Home Capital was taken private by Stephen Smith, who's your top shareholder, 20% shareholder. How does that sit with you to know that your top shareholder runs sort of a competitor?
Well, the bank's been listed for 20 years, and I've known Stephen for 32, so it gives you some sense of our relationship. It's never quite comfortable when a competitor, your friends also a competitor, but we've learned to live. We learn to live, and there's lots of things that we need to do to make the banking system have the right kind of level of integrity to be safe for Canadians and all those things. So in the whole environment, there's competition, good competition, not enough sometimes, but on the other hand, we have common interests in making sure the banking system stands up and is great and serves the needs of the public, and I think we can all work together on that.
Well, since you are pals, has he talked about maybe bringing EQ Bank along for the ride of privatized EQ?
No, we haven't had that conversation at all.
Do you think that kind of consolidation could happen? And I know you can't talk about whether you've had those discussions, but if you're a Canadian bank looking for growth in this country, why not snap up EQ Bank? I mean, do you think the regulators would even allow that?
Well, when you see HSBC, which is bigger than EQ, being allowed to be bought by Royal, presumably there are some that we could be combined with. and maybe others where that wouldn't be the case, depending on kind of different markets we're operating in. That's certainly not our agenda. Our agenda is to stand up for Canadians, be Canada's challenger bank, bring new competition to the market, bring value that isn't, in our view, provided today. And that's our kind of complete focus, and our team is focused and inspired by that mission to change Canadian banking and being a catalyst for change. So we're not looking to do that, and our world is all about building our business the way we have, which mostly has been about organic business, going out, meeting people, providing that value, providing a new way to bank, thinking about how banking can be better and more convenient and better value.
People are looking at, they always are. The short sellers are never totally gone from Canada housing. And unfortunately, EQB stands as one of the more pure play ways against that, though it hasn't obviously been successful. But there is a possible cliff coming with these wave of mortgage renewals and what that could mean for the Canadian economy, what that could mean for housing prices, especially if the economy is in a tough spot and jobs are lost. That's going to affect possibly home prices. How do you think about that evolution playing out?
Well, first of all, we're not that concerned about it. 85% of our customers have already repriced since the Bank of Canada started its easing cycle. So we feel most of our customers have already adapted to this higher interest rate world. So I don't really see it as a risk. There's a lot of equity in Canadian homes. We really feel that Canadians are well equipped to handle this shock, and it's not like it happens next week. It happens over the next 2 to 3 years, and we all learn to adapt to it.
Well, for more on the U.S. markets, let's introduce our featured guest of the morning. She's Nadia Lovell, Senior U.S. Equity Strategist for Global Wealth Management at UBS. And Nadia, it's always a pleasure to have you with us. Thank you so much for spending some time with us this morning. Let's talk about your view of the S&P 500. You and your team at UBS believe that we will hit new highs this year on the S&P 500, and that something that investors have wanted for some time, breadth will broaden, you believe, on the S&P 500.
Absolutely. We continue to think that this market is going to notch new highs. When you look at what's going on in the U.S. economy, it's on solid footing. I mean, even this past week, we had upward revision to the consumption portion of fourth quarter GDP. And then when you look at Atlanta Fed GDP now for the first quarter, that momentum seems to be continuing into the first quarter. Paul, you have it at about 3%. And if that happens, that's 7 consecutive quarter of above trend GDP growth for the U.S. And no matter how the consumer is feeling, well, as you noted, we'll get Michigan survey later this morning. But earlier in the week, we did see some weakness in the sentiment data, but the consumer is still spending. And that is going to help be supportive to corporate earnings. So we think that corporate earnings are likely to be in the high single-digit range this year. It could even get to double-digit earnings growth this year. That's going to help push the S&P towards our 5,200 price target. Yes, Paul, we're not that far from there, but our bull case does call for 5,500. But we think in order to get there, you need to see a faster recovery in the manufacturing side of the economy. We'll get ISM later this morning, so we'll see how those come in. And so we think that the elements are there to really, for this market to continue to grind higher and the bull market to continue.
S&P 500 closed yesterday at just under 5,100 points. You have adjusted your view of the Fed and what the Fed is going to do and when it's going to do it. Tell us about that.
Yeah, so, this is a hawkish tilting Fed. I mean, we've heard it in the rhetoric the last couple of weeks, and we even saw it in the January meeting minutes where you saw that most participants thought that the risk of, easing policy too quickly was greater than the risk of policy remaining restrictive for too long. And so this is a Fed that is in no rush to cut interest rates. And the market itself has come around to that view, and the Fed has priced in about 75 basis points of cuts for this year. Initially we were at 4 cuts for this year. We've recently lowered that to 3 cuts, and we pushed out the timing from May to June. So we weren't as offside as the market was at the start of the year when the market was looking for 6 to 7 cuts for this year as early as March. Reality is this is a Fed that is going to be data dependent and not expectation dependent. And I would say the PCE numbers yesterday didn't necessarily instill additional confidence in the Fed, and it might have to wait until around mid-year before we see a consistent cooling in inflation and also potentially some cooling in the economic activity to give the Fed that confidence that inflation is on that sustainable path back towards 2%. But all said and done, we do expect rate cuts this year starting around June.